Hi everyone, today we're going to talk about Microsoft's fiscal third quarter 2026. Numbers were reported on April 29th and, well, there's quite a story in here. Let's get into it. So here's the headline that landed in everyone's inbox on Wednesday evening. Microsoft's AI business across Azure, Copilot, Foundry, GitHub, all of it is now running at a $37 billion annual rate, up 123% year over year. Not double, more than double. That is the number that defines this quarter, and it's the reason we're going to spend the next 15 minutes unpacking what's happening inside this company. Before we dig into the numbers, let me set the stage. Microsoft today is really three businesses bolted onto one balance sheet. Let's look at how the revenue actually splits. Productivity and business processes, that's Microsoft 365, LinkedIn, Dynamics, $35 billion this quarter. Intelligent Cloud, which is mostly Azure plus the on-premises server business, $34.7 billion, almost the same size now. And then more personal computing, Windows, Xbox, Search, and Surface, $13 billion. The two big ones grew double digits. The third one, we'll get to that one. For context, Microsoft is roughly a $3.7 trillion company. It trades at about 37 times earnings, which is a premium even by big tech standards. Its real peer group isn't other software companies anymore. It's the 4 or 5 firms on Earth big enough to spend $100 billion a year on physical infrastructure, and that frame matters for the rest of this deck. The way Satya framed this quarter is important. He said agents, not chat, not Copilot, agents that do long-running tasks on your behalf are going to become the dominant workload of computing. And Microsoft is making two parallel bets to capture that. 1, build the infrastructure underneath. 2, build the agents on top. That's the entire thesis. Every dollar this quarter, every dollar of capex you'll see later, it all rolls up to that.
Okay, let's look at the actual quarter. 6 numbers, then we'll zoom in.
6 tiles, every single one beat what the street was looking for. Revenue, $83 billion, up 18%. Operating income grew 20. Net income, up 23. EPS, 427. The Microsoft Cloud, the part of the company that's actually growing, $54.5 billion, up 29%. And Azure, 40% constant currency, 40. After 3 quarters of mid-30s growth, this thing accelerated.
$82.9 billion in one quarter, up 18% year over year. That's the fastest revenue growth Microsoft has posted in 3 years. For context, this single quarter is bigger than the entire annual revenue of all but maybe 20 companies on Earth. Here's how $83 billion in revenue becomes $32 billion in net income. Cost of revenue takes the biggest bite, $27 billion, and that's where you can see the AI infrastructure cost landing. R&D, sales, and marketing, G&A, all manageable. You end up at $38.4 billion of operating income. After tax, $32 billion in net income. Operating margin, 46%, and that's actually up year over year, even while they're spending like maniacs on capex. Okay, this is the number that didn't make the press release headline, but it should have. Commercial remaining performance obligations, that's the contractually committed revenue that Microsoft has signed but hasn't yet recognized, is $627 billion, up 99% year over year. The book of business nearly doubled. That includes a chunky Azure commitment from OpenAI, but even excluding OpenAI, RPO grew 26%. Roughly a quarter of that $600 billion will be recognized in the next 12 months. The rest, that's the future. Locked in.
Now let's look segment by segment. Where exactly is this growth coming from?
Look at the slope. Productivity and business processes up 17, Intelligent Cloud up 30, and more personal computing basically flat, actually down a point. 2 engines on fire, 1 stalling. That's the shape of the quarter. Inside Intelligent Cloud, Azure grew 40%. That's the engine. Demand still exceeds what Microsoft can deliver, and they explicitly said it'll stay supply-constrained through 2026. The Fairweather data center in Wisconsin came online 6 weeks ahead of schedule. They added an entire gigawatt of capacity in just this quarter. They're on pace to double the total footprint in 2 years. Read that again, double in 2 years. Productivity, every line up double digits, but the line that matters most is Copilot. 20 million paid seats now. Seat additions grew 250% year over year. That's the fastest growth since they launched the product. Accenture alone has 740,000 seats. Bayer, Johnson & Johnson, Mercedes, Roche, each over 90,000. The enterprise rollout that everyone was questioning a year ago, it's actually happening. More personal computing, the one segment that's not really growing. Windows OEM, Xbox content, both down. Search advertising is the bright spot, up 9% constant currency. Worth noting, Bing crossed 1 billion monthly active users for the first time, and Edge has gained browser share 20 quarters in a row, so consumer's not dead, but it's not where the story is right now. Here's the portfolio in one chart. Bubble size is revenue, x-axis is growth, y-axis is operating margin. Productivity is up there in margin, 60%. Intelligent Cloud is over to the right in growth. Nobody's actually in the top right corner, high growth and high margin together. That's where the next leg has to come from, and that's exactly the bet. The cleanest number in the entire quarter. Azure grew 40%. And here's why that matters. The market consensus a year ago was that Azure would be in the mid-30s and decelerating. It's not. It accelerated, and Microsoft is guiding to 39 to 40% again next quarter. The biggest cloud is getting bigger faster. A few more numbers that tell you where this is going. 20 million paid Copilot seats. The number of customers with 50,000 or more seats, that quadrupled in a year. Nearly 90% of the Fortune 500 is building agents on Microsoft's platform. And on the developer side, 140,000 organizations use GitHub Copilot. The pricing model is also quietly shifting from pure per seat to per seat plus consumption because agents do work and work consumes compute. That changes the unit economics. Okay, we've talked about the money coming in. Let's flip the page and look at where it's going out. This is where the story gets more complicated. The cost line that's actually moving is cost of goods, up 22%. That's where AI infrastructure depreciation lands. R&D up only 9%. Headcount actually declined year over year. Sales and G&A manageable. So the company is being disciplined on the lines it can control, but it's leaning into the one line that's locked in by capex decisions made 12 to 24 months ago. Okay, look at the bars. A year ago, Microsoft was spending $16, maybe $17 billion a quarter on capex. This quarter, $31 billion in cash. Next quarter, they're guiding to over 40. That is not a cyclical bump. That is a structural step-up. About 2/3 of this is short-lived stuff, GPUs that depreciate in a few years. The rest is long-lived data centers that pay back over 15 years or more. Microsoft is locking in scale before competitors can catch up. $80 billion in capital expenditures over 9 months. To put that in perspective, that's bigger than the entire annual capex of ExxonMobil or Toyota. Microsoft is now spending more on data centers than the world's largest oil and auto companies spend on all of their physical assets, combined. Here's the cash flow picture. Operating cash flow this quarter, $46.7 billion, up 26%. The business is generating real cash, but capex took $31 billion of it. What's left over, call it free cash flow, was $15.8 billion. On top of that, $10.2 billion went back to shareholders in dividends and buybacks. The math basically zeroes out. Microsoft is funding the largest infrastructure build-out in corporate history almost entirely from the income statement. This is the bear case in one number. Free cash flow, $15.8 billion. A year ago at this point in the cycle, it was much higher. The company is still cash flow positive, just barely, but capex is eating most of what operations generate. If demand stays strong, this is fine. If demand falters even a little, the math gets ugly fast. One thing the bears get wrong sometimes, Microsoft hasn't actually levered up to fund this. Long-term debt is down, not up. Capital returns to shareholders held at $10.2 billion this quarter. Buybacks are actually higher year to date, so they're funding capex from cash flow, not from new debt, yet. That's the most important word on the slide, yet. Okay, now to the forward look. What did management actually tell us about the next quarter and the next year? For Q4, Microsoft is guiding $86.7 to $87.8 billion in revenue. That's another double-digit growth quarter. Azure stays at 39 to 40%. The thing to watch, Microsoft Cloud gross margin is guided down to about 64%. That's the AI infrastructure cost continuing to bite. And there's $900 million in one-time costs from a voluntary retirement program. Microsoft is still pruning headcount even as it spends record capex.
And the capex curve doesn't bend in Q4. It steepens, over $40 billion in one quarter alone. $5 billion of that step-up is just because GPU and memory prices are rising. For the full calendar year 2026, Microsoft expects to spend roughly $190 billion on capex, including about $25 billion from component price inflation. They expect to remain capacity-constrained through the end of the year.
$190 billion in one calendar year on data centers, GPUs, networking, power, real estate. That is more than the entire gross domestic product of Hungary. And Microsoft is going to do it again next year and probably the year after. This is the bet. It's not subtle.
For fiscal 2027, which starts in 3 months, Microsoft is committing to double-digit revenue growth on top of this year's already massive base. Operating expenses growing only mid to high single digits, so margins continue to expand. Headcount continues to decline. They're explicitly saying the spend is justified by demand they can already see in the book. Whether you believe them is the whole trade.
A quick word on competition. AWS is still the biggest cloud, but Azure is closing the gap. Google Cloud is growing fast and turning profitable. OpenAI is simultaneously Microsoft's biggest customer, its deepest partner, and increasingly a direct competitor in agents. And Anthropic, interestingly, is now also available inside Microsoft Foundry. So the model layer is becoming multi-vendor even on Microsoft's own platform. The next fight is going to be about agents, not infrastructure.
Okay, time to take a side, or at least lay out both sides honestly. The bull case is the AI numbers, 37 billion ARR, 627 billion in remaining contract obligations, 20 million Copilot seats. The bear case is the cost side. Free cash flow squeezed to under 16 billion, 190 billion of capex queued up for next year, cloud margins compressing. The bear case isn't crazy. Both sides have real numbers behind them. This isn't a one-sided trade. Here's what I'd actually watch over the next 2 quarters. Azure's 40%. Does it hold? Microsoft Cloud gross margin. Where does it bottom? Bookings x OpenAI. Can that 7% number reaccelerate? Free cash flow. Is the squeeze temporary or structural? The OpenAI relationship. Does it stay healthy as both sides build agents? And the pricing transition from seats to seats plus consumption. How fast does it actually unfold? 6 things. Each one moves the stock. Here's where I'll leave you. Microsoft today is a $3.7 trillion company, but the way it's spending, $190 billion in capex, doubling its data center footprint in 2 years, 20 million Copilot seats and counting, it's spending like a $10 trillion company. The bet is enormous. The early returns are real. The next 4 quarters will tell us whether this becomes the defining capital allocation decision of the decade, or the most expensive lesson in tech history. That's it for today. Don't forget to subscribe.